So I introduce these property, plants, and equipment. So write property, plant, and equipment in bracket PPE, in bracket PPE. So in this topic, you need to know the classification of long-term assets, relevant cost, method of estimating depreciation, and also how to do the disposals of these assets. How to do the disposal of these assets. How to do the disposals of these assets. So when we talk of property, plant, and equipment, we can define this one and say this is a schedule. This is a schedule that shows the movement of non-current assets. Non-current asset, that is motor vehicle, furniture, land, building. So motor vehicle, furniture, land, building, what else? Plant and equipment, and plant and equipment, and plant and equipment. So it shows that movement of this plant and movement. So when we say movement, well, so what do we mean by say it is the movement of these non-current assets? So this movement, you say, this movement involve acquisition, revaluation, and disposals, revaluation. So acquisition is simply acquiring new asset, right? Yes. So if we acquire new assets, we call it acquisition. So revaluation, this is simply the change in fair value of an asset. It is the change of fair value of an asset. It is a change of fair value of an asset. So this change, it can be either upward or downward, depending with the nature of the asset, And then the disposal is simply a sort of an asset. So in this topic, we will have to see, did we acquire an asset? Did we revalue an asset? Did we dispose an asset? And also, did we depreciate? So we also need to know a depreciation. There is also part of depreciation. What did we say about depreciation? Tulisema depreciation is a loss of value. Loss of value.
Loss. Yes.
Yes, it's a loss of value of of an asset, right?
Yes.
Or simply a reduction in value of an asset. If you don't want to use that one, a reduction in value of an asset. And we have done a lot of questions, and we have known the methods of computing or calculating depreciation. So far, you know which one and which one?
Yes.
The first method, Nigani, and we only have 3 methods, but there are 2 methods which is more examinable. The first one, Nigani?
Subtracting buying cost from, cost at the start of the month from cost at the end of the month.
That then we call, what do we call?
Counting.
You know how to compute, but you don't know the method you are using. If examiners tell you that take 25% on cost, what does that mean? Which method are you applying? Or do you just know 25% I'll have to multiply by the cost? So you should know the method you are using. And then also the examiner will tell you take 25% of the net book value. So you should know the method you are using. So if it is 25% on cost, then we are using a straight line. Method. Yes, we are using a straight line method. So straight line is you take the rate, multiply by the cost, or you take the useful life, you take the cost, divide by useful life. That's what we mean when we say on a straight line method. And then on the net book value, we use what is called the reduction or reducing method. Reducing, just say reducing. Okay. Reducing method. So in this topic, we will apply all these concepts. And also, when it comes to the practical, you also have to prepare that one. Maybe, you see, you taught this thing we are teaching you here, you only live in the school. No. If you look at this is audited statement of Tunya System Limited. So this is a real company. And if you check in the audited accounts, this is for 2024, December. If you go to the workings, you can check the statement of equity, even though we have not done that. We are doing this financial statement. Yes, there is you see, property, plant, and equipment. So there is a property, plant, and equipment, note number 9. So if you go to note number 9, you can see there is a classification of cost, accumulated depreciation, and the net book value. So even though this one, the person who was doing this financial statement, I don't know the format they are using, they have to give us in a pictorial or in a certain format. So this property, plant, and equipment is part of the working ukifanya any audit. So don't take it like near class peke yake, hapana.
Oh wait. Okay, there is
you have not written.
You can tell it. I can tell you not to erase the bottom part.
The bottom part. I said this one is depreciation is. So let me erase the first part. So this was the 25. This maybe, for example, 25% on cost, and then this is 25% on the net book value. This was a depreciation. No. This was method. Now we have the format. So we need to know the format of PPE. So you write PPE format, which we will start with the details. So the first asset can be land. Next is building. We can have motor vehicle, furniture, plants and equipment, and then total. And the total. So on this idea, we have balance brought forward. And then we will have, if there is any acquisition during the year, acquisition. So maybe even we have acquired one. And then revaluation. Revaluation. If there is any revaluation, maybe we have revalued land and motor vehicle, the other one remain constant. And then disposal. So if there is any disposal, maybe we have disposed motor vehicle. So disposal, you put a negative to show that we have disposed an asset. So therefore, this one we call it A. So make sure to show it is A. Then so I hope you have done with this.
Yes, I'm done with the bottom now.
So write that format. You're done with the first part?
Why isn't there disposal on land?
Yes.
Why isn't there disposal on land?
No, I'm just putting, for example, they can dispose any asset.
Yes.
I was just putting, for example, they cannot dispose all the. You will not be given a question which is disposing all the asset. But for example, it can be land, it can be building, motor vehicle, any asset.
Thank you.
Yeah. So then after that, we get to the closing balance. So you will add this, say this, you get the balancing here. So that one, we call it balance. This was the balance brought forward. So this one we call balance carried forward and name it B. Balance carried forward, then you name it B. Now, we have the second part, which is now the part of depreciation. So the second part is depreciation. The second part is depreciation, which will have balance brought forward. We don't depreciate land. We don't depreciate land. The others, we can depreciate that. Good. And then there is a depreciation for the year. So we have depreciation for the year. This is for the year. We don't depreciate that. We have this. And then depreciation again due to disposal. So depreciation due to disposal. So if you dispose these assets, that's what we are removing here. So we also need to remove the part of depreciation of that asset because it is no longer for us or it is no longer for that company. So they have to remove it from their books of account. So any asset which is disposed, we'll have to remove the part of that asset depreciation. So we'll have to remove that as the result. I have it here. Again, if there is any revaluation, then the depreciation of an asset will be affected. So we have depreciation due to revaluation. Depreciation due to revaluation. So if you revalue like motor vehicle or building, then the depreciation will be affected. Depreciation will be affected. They can revalue any asset. I'm not just saying that we cannot revalue the furniture. No, they can revalue any asset, even the land, but there is no depreciation for land. Therefore, this one we call it C. We will get, so if we add this, we get, don't underline with the two lines, just single line. So we'll have balance carried forward, and we call it D. Balance carried forward, and we call it D. So that, now assuming we were doing the statement from January 2024 to December 2024. So we will have here on 1st January 2024. So how do we get the balances of 1st January 2024? You take A minus C. So you take A minus C. So that you get the balances on 1st of January 2024. And then for you to get 31st December 2024, you take B minus D. B minus D. And you will be done with your property, plant, and equipment. You will be done with your property, plant, and equipment. Property, plant, and equipment. So make sure that the format is the key. So make sure that you be able to know the format. So if you can see, this one is the disposals of PPE. Do we have any? So I can say in most part of your exam, they ask you, it is part of the PPE, but they are not asking you the PPE, but we can even have all of them: motor vehicle account, depreciation account, and then we put it in the PPE account. So even if you can check in your question, you have not been asked the PPE account, this one, but the requirement which have been given is the steps which we use. So first, we need to open individuals' accounts like land, building, motor vehicle, furniture, and the plant and equipment. And also we need to open the individual depreciation accounts, disposal account. Then after that, we can just fill in this format. We can just fill in this format, which, yeah, we can just start by doing the calculation on how to calculate the depreciation. Thereafter, we will open this account. So in the question you shared, I can see question 1. Can do that question 1. Unaingia class ngapi?
I can go a bit later.
Okay. You're done with writing this format?
Oh, you erased almost. I'm writing the digits, but I'm done with the words.
So you are done, eh?
Like yeah.
So there is this question you sent for the disposal of PPE. It is written disposal of PPE. Question 1. This is question 1. That is disposal of PPE. That is the topic or the heading which has been written there. So which we have been told ABC company account for motor vehicle as 1st of January 2019 was 5 million. So that is the cost of the motor vehicle on 1st of January 2019, 5 million. While accumulated depreciation as that date was 2 million. During the year, the following transaction took place. Number 1, a motor vehicle bought on 1st January 2017 at 1 million was exchanged with the new one costing 1.5 million. So this is what is called at trade-in. At trade-in is that you give out an old motor vehicle in exchange of the new motor vehicle. They'll have to do the valuation of the old motor vehicle, and then they will see the cost of the new motor vehicle. Then any variance you will pay in cash. Any variance you will pay in cash, which we have been told the company paid shilling 800,000 in exchange, and the exchange took place on 30th June 2019. Yeah. So you can see the value, the land, the old motor vehicle was valuing 1 million, but the new one was costing 1.5. So, and they paid 800. So which means they valued the old one at 700,000. So that they paid the variance of 800,000. Now, number 2, on 1st July 2019, a new motor vehicle was bought at 1 million. Okay. On 31st July 2019, a motor vehicle bought on 1st August 2016 at the cost of 800 was sold at 300,000. So that is a disposal. Again, on 31st August 2019, a second-hand motor vehicle was bought from XYZ Limited at 700,000. And XYZ had bought the motor vehicle at 1 million. So we don't mind with what was the value of XYZ. We only mindful with the price which we bought the second-hand motor vehicle. Okay. We have been told it is the company policy to charge depreciation on the motor vehicle at 20% on cost. At 20% on cost. So when you say on cost, what should come to your mind? You should know that this is a straight line method. This is a straight line method. Yes, this is a straight line method. With the full year charge in the year of acquisition and no charge in the year of disposal. So you have to be keen on the policy. You can see we have been told and in full year, either in acquisition or disposal. So another examiner will tell you not in a full year, but in a pro rata basis. So you also need to know when it is a full year and when it is on a pro rata basis. So when it is a full year, we don't consider the date of acquisition or the date of disposal. We just need to calculate depreciation for the entire 1 year. But when it comes to the pro rata basis, you calculate the depreciation up to the date of acquisition, you put aside. You calculate from that date of acquisition, maybe up to the date of disposal, you put aside. And then you calculate the rest of the period. You combine all of them. That's what we call the pro rata basis. We will get a question also using a pro rata basis, so that you see how to approach that. Good. So with this, can just open the motor vehicle account. We'll be using a T account, debit, and credit. Balance brought forward, we have it 5 million. 5 million. Also, you can open on the same time provision for depreciation. Provision, which that's what we call the accumulated depreciation account. The accumulated depreciation account is what we call provision. So you can call accumulated depreciation as they have called it here. Accumulated depreciation. So we always take it on the credit side, the balance brought forward. So balance brought forward is 2 million. And also we can have depreciation for the year. Or depreciation account, just call it depreciation account. They have called it that, depreciation account. And that we will have disposal account. We have disposal account. So these are accounts which they need us to open. We have already put the balances. Now, number 2, we have been told a motor vehicle on first of that one was exchanged with a new costing that one, and the company paid that one in exchange. So there is a trade-in here. So when an asset increases, what do? We debit. So I hope you have not forgotten. When an asset increases, we debit. So we have a trade-in here. So we have a trade-in. So in this trade-in, we have a trade-in value, we have a trade-in value, and we have cash. So cash is costing 800,000, and trade-in value is costing 700,000. If you combine the two, you get the total of 1.5. You get the total of 1.5. You get the total of 1.5. So, okay, we have done with that. Note number 2, a new motor vehicle also was bought with 1 million. So there is also a new motor vehicle here. So maybe we can just say cash or bank of 1 million. Of 1 million. And then now, remember, here, you bought this machine, you bought a trade-in here, but this is a trade-in, but there is a motor vehicle which you gave out in exchange of this. So we'll have to remove it here by writing disposal. Yes, because we exchange with a new one, which is costing 1.5, and the old one was valued 1 million. 1 million. So, which you credit the motor vehicle account, you debit the disposal account. So you will come here and write the cost of motor vehicle, which is 1 million. Which is 1 million. So you can see debit and credit. You should have debit and credit. In every transaction of accounting, there should be two sides of the transaction, debit and credit. Now, even though we have not done to this, now let's see whether you got a profit or loss. Your machine was costing 1 million, but you dispose it at 700,000. 700,000. Yes. So this 700,000 is the cash proceed you received from disposing these assets. So you come here and write the cash proceed of 700,000. Even though we have not been given the accumulated depreciation of this asset, but we assume that was the net book value. That was the net book value. So if you If your machine was costing 1 million, you dispose it at 700. Is it a loss or a profit?
A loss.
It is a loss of 300,000.
300.
300,000. Yes, it's a
300,000.
loss. It's a loss of 300,000. So if we were opening the P&L, if we were to open the profit and loss account, we had to subtract this one in our P&L or to debit the P&L, the loss on disposal. Okay, so we are done with that note. We go to note number 3. A motor vehicle bought on first at the cost of 800 was sold at 300. This one is also another disposal. So there is another disposal of 800,000. And then it was disposed for 300,000. So you also come here, another motor vehicle, 800,000. The cash, ali disposiwa na 300,000. 300,000. So again, there is a loss of 500,000. 500,000. Again, there is a loss of 500,000. And then we go to number. So utajoin, sijui kama bado tuko na only 1 minute iko remain. So but you can still work on it. So you can say that we have been told that on that 1st August, second-hand motor vehicle was bought from XYZ at 700,000. So that is 700,000. So this is just a cash which they were bought at 700,000. We don't mind the cost, those people they bought it. So they will also account for the disposal loss and the profit. So, but us, we are interested in the cost we acquired this asset. So then we are done. So what we just need to do is to get the net book value, add this, subtract this to get the balance, carry forward. So let's have that 5 million plus 1.5 plus 1 million plus 700,000. So I'm getting 8.2 million. So subtract 1 million minus 800,000. So here I'm getting 64 or 6.4.